Imagine you're selling your business, right? But instead of just signing a contract with the buyer and handing over the keys, a judge forces you to physically track down and secure a signature from every single customer who ever walked through your door.
Yeah, I mean, that would be an absolute nightmare.
Exhausting, right? Well, welcome to another episode of The Riffle, a podcast series brought to you by 10 Leaves. Today is July 27, 2026, and we are doing a deep dive into a brand new consultation paper.
Number 2 of 2026, to be exact. And it was issued literally today by the Financial Services Regulatory Authority, the FSRA, over the Abu Dhabi Global Market.
Exactly. And the mission for our deep dive today is unpacking this statutory mechanism known as transfer schemes. This is the legal machinery under Part 7 of the Financial Services and Markets Regulations.
Right, the FSMR, which is basically what financial services businesses use when they want to transfer all or part of their operations to another entity.
So if you are running an authorized person or a recognized body in the ADGM, or you're just fascinated by how global financial hubs are desperately trying to strip away red tape without accidentally detonating the market, this is for you.
The timing of this paper is really critical. We're looking at a regulator wrestling with a fundamental tension. Like, how do you balance the agility required to do business in a modern hub with the non-negotiable necessity of client protection?
Right. And to wrap our heads around what the FSRA is proposing today, we kind of have to look at the mechanical reality of how businesses actually change hands, right?
Yeah, exactly. Because under standard contract law, if you run, say, a wealth management firm and you want to transfer your client obligations to another firm, you can't just unilaterally sell that contract. You need a legal mechanism called a novation.
Let's break down novation for the listener because it sounds like a simple paperwork exercise, but in practice, it is a logistical nightmare.
Oh, totally.
A novation effectively requires you to tear up the original contract you had with your client and force that client to sign a brand new contract with the new firm.
Which, is the ultimate form of client protection. Yes. The client has total agency. But scale that up. If you have 3,000 clients or 30,000 clients, relying on active novation is just paralyzing.
Yeah, you're asking thousands of people to read a legal email, print a document, sign it, and send it back. I mean, half of them are on vacation.
Right, or they'll just ignore the mail. Some will simply forget.
Yeah.
So you end up with this fractured portfolio where you can only sell the fraction of the business that actually bothered to reply to your emails.
You essentially have a stranded asset at that point. So the statutory transfer scheme under Part 7 of the FSMR was historically created as the bypass valve for this exact problem. Right?
Exactly. It allows a business to transfer its portfolio without needing to track down and get active consent from every single client.
But because you are stripping the client of their right to actively say yes or no, the system demands a substitute protector. Enter the ADGM courts.
Right. The court approval process was designed to be that ultimate protective shield. If a firm wants to bypass novation, they have to hire legal counsel, compile this massive dossier detailing the financial health of the acquiring firm, and basically stand in front of a judge.
And the court acts as an independent assessor.
Yeah, scrutinizing the entire deal to ensure that no client or third party is going to be adversely affected by the transfer.
Which, feels entirely appropriate. If a firm is going to move my money or my financial services to a new provider without my explicit signature, I definitely want a judge verifying that the new provider isn't, totally insolvent.
Absolutely.
So what does this all mean? If the court acts as the ultimate safeguard for the listener's assets, why is the FSRA proposing to dismantle this mandatory system? Because reading through this newly dropped consultation paper, they want to drastically overhaul this requirement.
Well, the application of this rule has just become a massive bottleneck. Currently, other than transfers of domestic funds, which are handled under a separate fund rulebook, every single business transfer requires this mandatory court sanction.
Wow, every single one.
Every one. And the friction is enormous. We are talking about months of delays waiting for a spot on the court docket, alongside just exorbitant barrister's fees.
And we really have to look at the specific market profile of the ADGM today, right? Because they don't primarily consist of massive retail banks shuffling millions of individual checking accounts.
Exactly. The ecosystem is heavily weighted toward firms with smaller, highly sophisticated corporate client bases.
So we are talking about an advisory firm restructuring and moving maybe 50 corporate clients to a new subsidiary. For a transaction like that, forcing them through a full judicial review feels like using a sledgehammer to crack a nut.
It really does. The legal fees alone would dwarf the administrative cost of the actual business transfer.
Right. But, and let me push back here for a second, are we just throwing client protection out the window to save a few bucks on legal fees? Taking away the courts entirely feels a bit risky for the average client? No.
Well, what's fascinating here is that the FSRA isn't removing protections. They're just making the regime proportionate. They're attempting to right-size the regulation.
Ah, okay, so narrowing the scope.
Exactly. They want to reserve the heaviest regulatory tool, that mandatory court sanctioning process, exclusively for the heaviest, most systemic risks.
Which leads directly to the question of what constitutes a heavy risk that still demands a judge's oversight. And this brings us to the core proposal of consultation paper number 2.
Right. The FSRA is drawing a very bold line in the sand here.
They are proposing to keep the mandatory judge and the court process, but only for one specific sector, and that is the transfer of insurance businesses. If a firm is transferring an insurance portfolio, they still need judicial oversight and a formal scheme report to ensure policyholder rights are protected.
Because the mechanics of insurance dictate this exception. I mean, insurance is fundamentally different from a standard financial advisory account or like a stock brokerage.
How so?
Insurance involves what we call long-tail prudential risks.
Let's unpack long tail for a second. If I buy a cup of coffee today, the transaction is over instantly. If I open a stock brokerage account, I can monitor my balance daily. And if I don't like the new firm managing my account, I can just liquidate my assets and walk away tomorrow.
Right. The risk is short and visible. But if you purchase a life insurance policy, or if a corporation buys long-term liability insurance, you're paying premiums for decades in exchange for a promise that the insurer will be solvent enough to pay out a claim 20 or 30 years down the line.
That massive gap in time, the tail, is where the vulnerability lies. A policyholder is essentially locked in.
Exactly. You cannot easily pack up a 20-year life insurance policy and take it to a new provider without facing massive financial penalties or losing your accrued benefits.
You are trapped with whoever holds the policy. So if my life insurance is transferred to a new firm, and that firm quietly goes bankrupt 15 years from now, I have lost decades of equity. The prudential risk is terrifyingly high.
That justifies the velvet rope. The FSRA is saying, look, because policyholders are so captive and the timeline is so stretched, we absolutely still need an independent judge reviewing a formal scheme report. We have to guarantee the new insurer can honor a claim in the year 2050.
But wait, even within this incredibly strict insurance mandate, the FSRA has carved out 2 highly specific exceptions where a firm doesn't need a court, right?
Yes, they have. The first is an intergroup transfer of insurance business where all policyholders have consented.
Yeah.
And the second is a transfer of reinsurance business where the ceding insurer has consented.
Okay, and just for context, you pointed out earlier that this actually mirrors the UK, where certain limited types of insurance transfers are similarly excluded from mandatory court sanctioning.
Yep, it aligns perfectly with the UK approach.
But here's where it gets really interesting. And honestly, let me challenge the logic here. If insurance is inherently so complex and dangerous that it needs a judge, why do intragroup transfers and reinsurance get a free pass? Isn't that just a convenient loophole for the big players? Intragroup just means moving a portfolio between subsidiaries of a giant conglomerate.
This raises an important question, but you're identifying the exact friction point between contract law and regulatory protection. We have to look closely at the mechanism of those 2 exceptions. The key word in both scenarios is consent.
Okay, consent.
The entire foundation of the court process exists to protect clients when their business is being transferred without their explicit agreement. If an insurance firm actually manages the logistical miracle of achieving 100% active, written consent from every single policyholder for an intragroup transfer,
they've functionally achieved novation. They did the impossible and got thousands of people to read the email and sign the document.
Exactly. And if the clients have explicitly said yes, the fundamental legal risk of them being moved against their will evaporates, forcing them through a massive judicial process when everyone has already legally agreed is just bureaucracy for bureaucracy's sake.
Wow. Okay. That makes sense. But what about the reinsurance exception? Getting 100% consent from individual policyholders sounds impossible. So how does a firm actually achieve that in a reinsurance scenario?
Well, it helps to understand the mechanism of reinsurance. Reinsurance is basically simply insurance for insurance companies.
Right.
Think of a primary insurer that sells hurricane coverage to thousands of homeowners. If a megastorm hits, That primary insurer would go bankrupt, trying to pay out thousands of claims at once.
So they protect themselves.
Right. They buy a massive policy from a reinsurer to cover those catastrophic losses. In this dynamic, the primary insurer is called the ceding insurer because they are ceding their extreme risk to the reinsurer.
Which means the thousands of individual homeowners have absolutely no idea the reinsurer even exists.
Right.
Their contract is only with the primary ceding insurer.
Which makes obtaining 100% consent mathematically feasible. The reinsurer doesn't need to track down 50,000 homeowners. They only need the consent of the single ceding insurer who acts as the proxy for all those underlying policies.
Ah, I see.
And because the ceding insurer is a highly sophisticated financial institution capable of evaluating corporate solvency, their consent is legally robust enough to bypass a judge.
So if we map the terrain here, insurance transfers must still go to court, unless you pull off the miracle of 100% active consent. But for the vast majority of non-insurance financial transfers, the wealth managers, the brokers, the corporate advisors, the judge is completely removed from the equation.
Entirely removed, yes.
So if we are removing judicial oversight for 90% of the market, what stops the market from turning into the Wild West? What is the brand new framework they're proposing?
The regulator is filling the void with what they call the Modified Transfer Scheme, which is housed under Chapter 8A of the General Rulebook, or GEN.
Okay, and this framework replaces the judge with 3 mandatory minimum safeguards, right?
Yes. First, prior written notification to the FSRA. Second, direct client notification. And third, a public notice.
Let's test the mechanics of this with an analogy. Under the old rules, transferring a business was like swapping the engine out of an airplane mid-flight. You needed an FAA inspector, the judge, to physically examine the new engine and sign a certificate before you could swap it.
I like that analogy.
But under this new modified transfer scheme, it feels like I just have to radio the control tower, the FSRA, tell my passengers to buckle up, which is the direct client notification, and then make a public announcement on the intercom.
Essentially, yes.
My question is, what if the new engine is a complete dud? What if the new landlord acquiring my portfolio is totally broke? We are relying heavily on direct client notification, but what does that actually mean in practice?
Well, the paper explicitly demands that direct client notification must be meaningful. A firm cannot just send a vague email stating, hey, we are under new management.
So what do they have to include?
The notification must contain a clear, detailed explanation of the potential impact the transfer will have on the client. It must explain any changes to fee structures, alterations in legal standing, shifts in service agreements, everything.
But even with a detailed letter, the client is still just a passenger on the plane. If they don't like the new engine, their only real recourse is to close their account and leave. Does the FSRA actually have the teeth to stop a dangerous transfer before it happens, without a court order?
If we connect this to the bigger picture, this is where we hit the most fascinating paradox of this entire consultation paper. By removing the judge, the FSRA actually gains more real-time, direct control over the market.
Wait, really? Because it seems like less control.
It's actually more. Because prior notification is not just a polite heads up. When the FSRA receives that written notification, the regulatory machinery activates. They have the explicit statutory runway to seek further information, to impose binding requirements on how the transition is handled, or to flat-out object and halt the transfer entirely.
Oh, wow. So the protective shield didn't disappear, it just changed hands.
Exactly.
A judge evaluates a transfer based on whether it is legal and fair according to the evidence presented in a dossier. But the FSRA evaluates the transfer based on live market intelligence. They look at the acquiring firm and ask, are they adequately capitalized? Are they holding the correct licenses? Do they pose a systemic risk?
And if the answer to any of those questions raises a red flag, the FSRA wields the power to shut it down right then and there. But the regulator also acknowledges that not all financial institutions pose the same level of systemic danger.
Right.
So they have engineered an additional layer of friction into this modified transfer scheme for specific high-risk entities.
Which brings up the banking and insurance caveat. The paper highlights banks, along with those 2 insurance carve-outs we discussed earlier, intragroup and reinsurance transfers.
For those specific entities, merely notifying the FSRA and waiting to see if they intervene is not sufficient. They must receive an explicit, written, no objection acknowledgement from the regulator before the transfer can legally proceed.
Let me ensure I am visualizing this correctly. If I run a standard corporate advisory firm, I send my written notification to the FSRA, I send the detailed impact letters to my clients, I post a notice on my website, and unless the FSRA explicitly jumps in to stop me, the transfer moves forward.
Correct.
But if I am a bank moving millions in deposits, I cannot move an inch until the FSRA officially writes back and says, "We have reviewed the prudential risks and we have no objection. You are cleared for takeoff."
That distinction is the hallmark of proportionate regulation. If a small advisory firm fumbles a transfer, it's highly disruptive to their 50 clients, sure, but the broader economy doesn't flinch.
Right. But a bank.
Exactly. If a bank bungles a massive transfer of deposits or a reinsurance giant miscalculates an intergroup portfolio shift, you are flirting with regional financial instability. The explicit no objection mandate guarantees that the FSRA has the time and authority to deeply audit the financial stability implications before a massive systemic shift occurs.
It is a brilliantly tailored approach. But, you might be listening to this and wondering, if a firm is legally allowed to bypass the courts and save tens of thousands of dollars, why on earth does the consultation paper explicitly state that the court process remains entirely optional for non-insurance transfers?
Ah, yes, the optional court use.
The door to the courtroom is intentionally left unlocked. Why would a firm voluntarily subject themselves to a 6-month legal gauntlet if they don't have to?
Because in the world of high finance, legal certainty is a highly prized commodity. Imagine you are executing a transfer scheme that involves multiple international jurisdictions, a massively complex web of proprietary assets, and thousands of institutional clients.
Okay, yeah, that sounds messy.
In a hyper-complex scenario like that, relying purely on regulatory non-objection might leave you vulnerable to future civil lawsuits from disgruntled third parties.
So if a client loses money 3 years down the line, they might turn around and sue the transferring firm, claiming the original transfer was handled improperly.
Exactly. But if you proactively choose to go through the mandatory court sanctioning process, you emerge with a definitive order from an ADGM court judge explicitly sanctioning the transfer. A judge has formally declared on the legal record that the transfer is fair and equitable.
That judicial stamp basically acts as an ironclad insurance policy against future litigation.
It provides absolute legal finality.
So if you have a straightforward domestic corporate transfer, use the modified transfer scheme, save the capital, and stay agile. But if you are untangling a massive, multi-jurisdictional web of accounts, volunteer for the judge so your legal exposure is neutralized. The market is being handed optionality.
Which really indicates a highly mature regulatory environment. The regulators recognizing that a one-size-fits-all mandate is stifling growth, and they are actively restructuring the architecture to fit the actual participants of their market.
If you are an executive or a compliance officer operating within the ADGM, the so what of this deep dive is immense. This consultation paper is a masterclass in regulatory evolution. It demonstrates a financial hub systematically hunting down operational drag and replacing it with transparent, data-driven regulatory oversight.
It really does.
But the most crucial takeaway for you, the listener, is that this is currently an active consultation. The FSRA is actively soliciting your feedback on the mechanics of this shift.
The consultation window is open right now, and the deadline to submit comments is September 21, 2026.
If you foresee a danger in removing judicial oversight for wealth managers, or, if you believe the notification timeline needs adjustment, you need to weigh in, you can send your feedback directly to fsra.consultation@adgm.com.
And a critical tip from the paper itself, comments supported by clear reasoning and empirical evidence will carry significantly more weight.
Right. Do not just send an email saying you love the idea or hate the idea. Show your work. Explain exactly how the proposed rules will practically impact your firm's operations.
As we conclude our analysis of this proposal, it leaves us with a highly provocative thought regarding the global financial landscape to really mull over.
What's that?
Well, if the ADGM successfully proves that real-time regulatory notification and transparent client communication can safely replace the heavy hand of judicial oversight for everyday business transfers, could this modified framework become the blueprint for dismantling legacy legal hurdles across other major financial hubs?
That is a fascinating point. We really have to ask ourselves, how much of our current legal bureaucracy is actually protecting the market, and how much is simply the ghost of an old system we maintain entirely out of habit?
Exactly. The ultimate irony here is that by removing the judge for 90% of transfers, the regulator is actually securing more direct, immediate control over the safety of the market.
Next time you find yourself buried under a mountain of required legal filings for a seemingly straightforward transaction, you might find yourself wondering, is this actually keeping anyone safe? Thanks for joining us on this deep dive. Keep questioning the system, and we'll catch you next time.